Welcome to the Modern Wealth Market Update, where we take a quick look at stocks, bonds, and the economy. I'm your host, Stephen Tuckwood, Director of Investments. Let's get going. In February, the US stock market turned lower, with the S&P 500 falling by 1.3% after gaining 2.8% in January. Most of the decline occurred during the last 7 trading days after the index hit a new all-time high on the 19th. Stocks ended the month with a year-to-date gain of 1.4%. Sector performance was diverse, with defensive sectors like staples and healthcare, and interest rate sensitive sectors like real estate and utilities performing the best. The more economically sensitive sectors such as industrials and consumer discretionary performed the worst, indicating investor concerns about the future for economic growth. From a market cap and style perspective, large cap value stocks greatly outperformed large cap growth stocks, but the trouble was felt most acutely in smaller cap companies, with the small cap value index down by almost 4% and the small cap growth index declining by almost 7%. In overseas markets, many countries outperformed the US again this month, benefited from the tailwind of a declining dollar. Germany and the UK performed well, with China as the standout. Brazil and India performed poorly. Bonds performed well in February after a good January, with the US aggregate bond index returning 2.2%, bringing it to a gain of 2.7% for the year so far. Both Treasury bonds and corporate bonds were generally in line with the broader index, with the mortgage-backed securities outpacing both of them. Finally, there was no Fed meeting in February, but the futures market expects the Fed to remain on hold until June. Headline inflation edged higher for the 4th straight month in January, and interest rates across the Treasury curve declined on concerns about the impact that tariffs may have on economic growth. That concludes your market update for February. If you have any questions, please reach out.